Hello, Assalamu alaikum, and very good day. This is the second lecture in the series of the Financial Market Institution course. In this particular lecture, we are going to talk about the structure of the financial markets. Please subscribe this channel for the further intimations about the videos. In this particular lecture, we are going to talk about how the different markets are classified. Like say, for example, how do we categorize different markets? In this categorization, actually, we divide the markets either on the basis of the nature of financial instruments, like say, for example, that which kind of financial instruments are being traded in the market actually make the market different from others. The functions of the financial markets, like either they are the primary market or the secondary market. Similarly, we can also categorize the markets on the basis of the levels of organization and the period of instruments, that for how long the instruments are being issued and received. We can also divide the markets on the basis of participants, like who are the participants? Are they the individuals are participating in this market, or the institutions are participating in this particular market? We can also classify and differentiate the markets on the basis of geography. Like say, for example, either the market may be domestic or an international market. Initially, we are talking about the classifications based on the nature of financial instruments. When you go to the financial markets, either you lend your money or you invest your money. When you lend your money or you borrow your money, borrow some money, that is actually is the operations that happen in the debt market. The instruments that basically are traded in these kind of markets are the debt instruments, which actually show your entitlement of receiving the interest rates for the money that you have lent to some organization. And at the end of the period of maturity, you get your money back. Similarly, if you are operating in the equity market, you actually are buying equity instruments, and these equity instruments comprise stocks. And these stocks basically show your partial ownership of the company. And this partial ownership is basically, make you entitled for the profits and losses in the company. Similarly, the derivatives can also be a market. The derivative markets is a market where such assets or such instruments are traded, which are backed by some kind of asset. The second kind of a classification can be based on the functions that the markets perform. Like say, for example, that can be a primary market and that can be a secondary market. The primary market is a market where newly issued financial instruments are sold for the first time. Companies, governments, and other issuers raise capital by issuing new securities directly to investors in the primary market. In these kind of markets, the investment bankers facilitate these kind of companies to launch their shares, and they underwrite their shares. Similarly, the shares which basically are issued in the primary market are traded in the secondary market. It is as same as, say, for example, the new car is issued from the showroom of the company, but that actually once it is bought from the company, it is resold into the secondary market. The secondary market of the shares basically provide the chance for the people to exchange their shares for money. That actually provides the liquidity. In Pakistan, the secondary market basically is the Pakistan Stock Exchange. And that involves a lot of people, and most of them basically are the brokers or dealers. Similarly, we can classify the markets on the basis of the level of organization, how they're organized. If they're organized in a certain kind of boundaries, they are basically have got a certain place where the trade is actually taking place. This is called exchange. But if the operations are decentralized, and the financial instruments are traded directly between the traders and sellers, basically are actually happening at the decentralized. This is called over-the-counter markets, and these over-the-counter markets are quite also common all over the world. Similarly, the classifications of the financial markets can also be based on the periods of instrument. The period of the instrument means that for how long this transaction between or the trade between the people are taking place. Like say, for example, if you are borrowing and lending for a period less than 1 year, that is actually a short term. And if you are borrowing and lending for more than 1 year, that is called a long run. The short-term instruments are traded in the money market, whereas the long-term instruments are traded in the capital market. The money market actually deals with a very short-term debt securities, typically with maturities of 1 year or less. It focuses on providing liquidity and includes instruments like treasury bills and commercial papers. Why these money markets exist? The reason for them to exist is that there are some people basically who require money for a shorter period of time. They need money for the overnights or for 2 days or 3 days or sometimes 1 month or 3 months or 6 months. They basically cater the need of these kind of people. Similarly, the capital market is for the people who want to make long-term instruments or investments in the long-term instruments, like say, for example, the shares and the long-term bonds. Similarly, the classification can also be based on the nature of the participants. Either the individuals basically who are participating in the market are individuals or institutions. Like say, for example, the retail market involves individual investors who trade securities for personal investment purposes. You may also have got some participants who are institutional. And institutional participants are those people who actually have got a lot of money collected through different kinds of ways, like say, for example, banks. Bank is a depository institution that receive deposits. What does the bank do with their deposits? It invests into the market. So actually, when it goes to the market to invest the money which they have collected from deposits of the different people, like that is called institutional investors. Similarly, and pension funds. Similarly, the insurance companies. They do not invest for themselves; they invest for the other people. Whatever the returns they get, they actually don't keep all of them with them. They just share it with the people, like with for whose money they actually have used. Similarly, the classification of the markets can also be based on geography. If your market is within your nations, within your country, that is called the domestic market. Like it is a domestic market. Like, say, for example, when you borrow in land for your domestic savings, this is called the domestic market. But sometimes, basically, like you need to increase your portfolio and you go to the international market. And sometimes you have to go to the international market because the local savings are not enough to meet with your requirement of the local investments. So when you have got less savings than the investment requirement in the domestic market, you have to go to the international market. But somehow the international market actually provides you the bigger horizon, where you can get money from the different nations. Like say, for example, a Pakistani company or Pakistani government can issue shares in England or US or kind of China or somewhere like wherever they like. And thank you for joining us. In the upcoming lectures, we shall be focusing on the different kind of the aspects of this particular kind of lectures. Thank you very much.